What's going on YouTube? It's Ganimo and welcome back to our channel. So over the past couple of weeks, we've been asked several questions from friends and family, especially colleagues, about some of the things we posted on YouTube. And although they're not commenting on the channel, they like to text us and ask us in person. So in this video, we decided to actually answer some of those questions. So let's get started. You guys know that drill. Gingerly tap that like button and let's get started.
So we're going to be breaking up our 10 most common questions into a video series. So let's dive in.
What is an emergency fund?
So an emergency fund is 3 to 6 months worth of living expenses placed aside into either a checking or a savings account just in case of an emergency. So what that means is if your monthly living expenses, and that's including rent, utilities, car, gas, or any truly necessary funds that you basically have within that month, are put away into a checking or savings account. And we recommend an online interest savings account because that money is very easily accessible. It can be transferred into your checking account within 2 to 3 business days. And basically it offers you 1.5 to about 1.8% on your money. So if you put $10,000 into the online savings account, you're actually making money and you can keep it there in case of emergencies. Now remember, a recent study actually showed 40% of Americans don't even have $400 worth of cash on hand in case of emergency comes up. So this is very important for you guys to have just in case of that. And you can't really foresee the future, and having that cash really kind of eliminates any stress.
So before you even consider the option of investing your money, make sure that your emergency fund is always well funded. And if you ever tap into that money, make sure that you always go back in there and replenish that money. And like Gan said, make sure that you always have that money in an interest-bearing savings account so that money is actually working for you in the meantime. So let's say you want to segue into investing. So what can you do? In my case, I like to invest in real estate. And what I do is that I keep 6 months worth of rent roll so I can cover any emergencies, any repairs, and any vacancies that may arise.
All right, on to our second question.
If I have $1 to invest, where should I invest it?
Oh, that's easy. Scratch off, lottery ticket. I mean, if you win $20 million, you definitely should not listen to any investment advice from me. But in all reality, investing in yourself, try to buy a book, try to get some information that's going to help you grow and to secure your future by empowering you with information that's going to help you quadruple your money over time. But if you want to segue into investing, you can always buy fractional shares of any company. What a fractional share is, for instance, let's say a company is worth $100 per stock. What you can do with that $1 is buy 1/100th of that stock, and that's going to teach you how to start investing overall.
So that $1 in an S&P can actually give you 8 to 10% return. And that $1 that you just invested, you put it there, let it go, and get a nice little return. If you don't win the lottery, but if you do, don't forget about Ganimo.
Third one.
Is this a good time to invest in the market?
Common question and a great question. Investing in the market right now may actually be very lucrative in the long run. Now this all depends on your financial status and how aggressive you may want to invest in the market. For instance, if you have any high interest credit card debt or if you didn't set up an emergency fund, those should be your primary factors before you even approach the idea of investing in the market. Now for me, for instance, I like to invest in low cost index funds such as the S&P 500. Why? Because I don't really worry about the stress. I'm not trying to time the market, and I know historically the returns have been 8 to 10%. So although we're talking about a recession, I know based on history that the recession, once it clears up and we actually go into a correction, those funds may actually give me some good return in the long run.
So yes, it is absolutely the best time to invest in the market, only because there is no good time to invest in the market. It's always going to be relative to your risk level. So trying to time the market is always going to end up being a losing game. And for the desired returns that you guys would like, which are between 8 to 10% given the market average returns, you should always be dumping that money in. Now, there's 2 different ways to dump the money in. Number 1, you can dollar cost average your money, which means that you are dividing your money into equal different portions and then trying to buy the market month after month. Another way is just to put all your money at one time, which is just a lump sum investment. Now, historically, different data has been shown over the last 30 or 40-year time period that the lump sum investment is always going to yield a higher return. As such, it's never a good time to try to time the market because you don't know when that time period is going to be. And in a given year, there's only about 2 or 3 days that will make the overall returns for that year. So trying to time the market, you're always going to end up missing out on those days.
Question number 4.
What is the benefit of having interest-bearing savings account versus a general savings account, and how do I open one?
So, an interest savings account is the one that you're able to open at your local bank branch, and they usually come with an interest rate of 0.01% and a 0.05%. Typically, you're able to drive over to the local bank branch, put your debit card in the machine, and pull your money out. Now, I don't really like them too much because the interest rate that they pay you guys is so low, but it does come with the flexibility of being able to access your money by driving over to that bank. Now, another thing that's associated with those different accounts is that you have to pay a maintenance fee on a monthly basis. And that is going to have to be paid as long as you keep that account open. And they usually have minimum balances to keep those accounts open as well. Versus the interest-bearing savings account, which you can open online, which include Ally Bank, for example. They typically pay between 1.55% and 1.8%. So your money is actually making a lot more money during that time period, and they typically don't have any different maintenance fees, and they don't have minimum balances as well.
So for me, for instance, I have my money in a checking account that can cover my monthly expenses, and I budget that appropriately with my rent, utilities, and my car payment. But I have no money sitting in a savings account, and you know, the minute you go to the bank, they're going to ask you, well, do you want to open up a savings account with that? And before you know it, you forget about that, and they're charging you $5, $10 a month because you're keeping below their minimum balance. So what we did was we actually moved all our money over to an online interest savings account. Mo uses Ally. I actually use Marcus by Goldman Sachs. And there's Capital 360 to offer good rates. Pick and choose at your own rate. And that's kind of the way that we go, and that's the way we recommend.
On to question number 5.
If I'm in graduate school or residency, should I invest my money or pay off my credit cards?
This is such a common question I get asked throughout the day by my co-residents and colleagues, and they know this is about them. But you should always pay off that high interest credit card debt first before you even start investing. Before you even start creating an emergency fund, if you have any credit card debt, $1, $100, $1,000, pay it off. Because if you look at the fine print on credit card statements, they can start charging you 19%, 23%, 25% interest on that credit card statement. And if you miss a payment, for instance, in your student loans, or if you didn't set up a direct deposit through any one of your accounts that you have, name it utility bills, whatever the case is, they can start charging you 80 to 90%. So if you want to talk about credit score, that's going to highly impact you. And you do not want to fall victim to credit card debt.
I don't want to even sound insulting when I say this, but none of you guys are going to be the best investor in the world trying to beat a credit card. Credit cards usually carry between 20 to 25% with interest that you have to pay on. And the best investment that you're going to be finding is going to be paying you between 10 to 15% if you're lucky. There's no way you can beat that. And that is what's taking so much unnecessary risk with your money. So please always pay off that credit card.
So now that Mo drank all my coffee and we finished our first 5 questions of our 2-part series, gingerly tap that like button. Don't forget to press subscribe and the bell, and we'll see you next time.